Welcome to ISG's quarterly call, summarizing the fourth quarter of 2017. My name is Howard Coleman. I'm the Chief Investment Officer of Coldstream, and with me today is Nina Rose. Nina is a portfolio manager here at Coldstream, and she'll be providing the market recap today. I will present our special topic for this call, it is corporate tax reform. There is a box on your screen where you can type in any questions you might have. We'll try to address all of your questions today, but if we do not get to them all, please contact your relationship manager or your portfolio manager with your question. While we have scheduled this call for 30 minutes, please bear with us if we run over by 10 or 15 minutes. And I think we may in this call because corporate tax reform is a rather complex topic. So please bear with us so that we can cover these topics well for you. Now for the market recap. Nina?
Thanks, Howard. Really appreciate that. Well, this is my third year in doing the market recap, and this is probably one of the best return years that I've seen, at least in the last 3 years. And I'm sure you all can appreciate that by the balances in your 401ks and portfolios. This year can certainly be described as a rising tide is lifting all boats. Every major asset class participated in growth this year, not just here in the United States, but also globally. We'd like to think of this as more of the synchronized global growth. Let's take a look now at what's going on in last year around the S&P 500. There's a couple of notable things that actually happened this year, but I'm going to start off by mentioning that after the election, the S&P 500 certainly did expand and accelerate excessively. January turned around and we ended up seeing an additional robust year in the S&P 500. The conversation this year had a lot to do with taxes and deregulation as the wind at the back of equities. The other issue that we were excited about and the market was getting ahead of itself about was repatriation of US dollars, which would significantly benefit large multinational corporations. This year, we saw a series of record-setting highs in the S&P 500, but the also notable difference in the S&P 500 this year was a lack of volatility. And on the screen, what you're looking at in the top box is you're going to notice that there was never any significant drawdown in the S&P 500. So we'll take look a little bit further as to why later in the presentation. But as of now, we can turn the page over and take a look at the Russell 2000, which is the smaller cap section of our marketplace. Now, small caps tend to be much more sensitive to taxes, and as I mentioned, the mood in the market was taxes, deregulation, and repatriation of US dollars. As you can see on the chart, the Russell 2000, or the small cap stock, didn't necessarily participate right out of the gate. The mood in the market wasn't really sure that the administration was going to be able to get tax reform off into 2017. The circle that you're looking at going into the third quarter was the market started to capitulate, or at least small caps started to think that taxes weren't going to happen. And shortly thereafter, the Republicans unveiled their tax plan. And as you can see by the Russell 2000 and the chart, the market continued to take off and rally around the fact that the tax plan was actually put in place. Now, one thing I did manage to discuss a little bit was noticing that we didn't have any major drawdown, any major volatility in the S&P 500. This, what we're looking at is really a chart of volatility. We think of volatility as volatility reminds us that there actually is risk in the marketplace. Sometimes the volatility is what holds us back from owning completely, totally all risk assets. One thing to think about that we want to look at, what's unique about this year, is if you look on the right-hand side, on the maximum drawdown chart on the right-hand side, you're going to see a very, very small little red dot. That dot represents the level of drawdown that we had in this year's 2017 marketplace. What's unique about that is that it's been almost 100 years that we've had this minimum of a drawdown. Now, what does that mean to us? Well, it could mean that we got very complacent in the marketplace last year with the anticipation of all of the good things that were going to be coming down from a public policy perspective. But what we need to be mindful of is 2018, we should see some level of volatility. And frankly, I think we are hoping to see some sort of a shakeout. So to just shake out the loose hands that are currently in the marketplace. Now, setting new highs in the S&P 500 and watching a market that we saw unfold certainly lends itself to asking the question is the market undervalued or overvalued? And by any measure that we're looking at right now, the market seems a little bit on the most richly valued side. The top box has a number of different ways that we are valuing the market. The more common way that I think most of you are aware of is price to earnings multiple. And the chart is demonstrating the price to earning multiple that currently is in the marketplace of 18.5 times earnings. If you see the dotted line, the double dotted line across the middle, that's our 25-year average. And as you can tell, things seem to be a little bit on the rich side. Now, just because we're trending above long-term averages doesn't necessarily mean that we need any type of price correction to get back to averages. But what we do need to ask ourselves is this valuation being supported by earnings? And lo and behold, as I mentioned before, as we got into the first of the year, the market really got ahead of itself in anticipation of tax reform. But as we started to uncover Q1, Q2, and Q3, estimates were being beaten this year. Corporations are very, very healthy at this time. For the most part, about 75% of the S&P 500 beat their earnings estimates and actually raised the estimates for the following year. So what does that really mean for next year? Think of it this way. We had tremendous earnings estimates from corporations this year. And going forward, we now have a tax policy that's in place. So if corporations do absolutely nothing next year, they actually are going to improve their bottom line because they're going to be paying fewer taxes next year, whereby putting those earnings back in their pocket. So I wonder if we do wonder, and we are starting to be able to justify that 18 times earnings may not necessarily be that rich when you think about earnings expansion next year, not just due to the health of corporate America, but also for the pure fact that the tax reform that Howard is going to talk about a little bit later is really going to be accretive to corporations' bottom line. Now, the question that we end up getting most often is, well, last year was terrific, really enjoyed it. What's going to happen for next year and what's around the corner? We're data-driven folks here at Coldstream, and so we look at things called the leading economic indicators. The reason why we've placed so much value on these indicators is, as you can see by the gray bars that are vertical, those are recessions. And prior to going into a recession, typically about 18 months to 2 years, leading economic indicators start to roll over or get weak. It's a sign to us that we may want to be much more cautious. If we're looking ahead to 2018, leading economic indicators by the blue line that you're looking at are pointing up. These indicators can be anything from unemployment claims, durable goods orders, or even housing starts. By all indications and by all data, the market appears that the next 6 months is very positive and we should continue expanding at the pace that we are expanding at. Now, one of the questions I know a lot of our PMs get, portfolio managers end up getting is, are we due for a correction? Are we due for a recession? And the question we have to ask ourselves is, as I've said, next year is starting to look very good. We've actually been in a recovery for quite some time. Our gross domestic product on the chart on the left-hand side has been a little subpar than it has been historically. But when you look at the right-hand side, what you're looking at is a chart. The red lines are previous recessions and how our economy has grown out of that recession. The blue line is the one is what currently happened after the 2008-2009 recession. And what you can see is we had a very shallow recovery. And because the recovery was so shallow, we actually think that this can go on for much longer. Time isn't necessarily something that's going to stop the expansion of our economy. Other factors are what's going to trip up our economy, and it may be federal interest rates getting risen, it could be public policy, it could be geopolitical risk. But at this point in time, we're not concerned about the length of the expansion because the expansion has been shallow. One area of the market that we often like to take a look at to kind of tip our hands as to what's going on is the interest rate market. So is the yield curve. Now, last year, Janet Yellen raised interest rates 3 times and tipped her hand that she'd like to raise interest rates an additional 3 times this year. We have a new Fed governor coming in by the name of Jerry Powell, and so the market is going to have a little bit of time to digest how Jerry Powell is going to handle things. But the main takeaway here from this chart is the red line is where interest rates were last year, the blue line is where interest rates are this year. Now, the Federal Reserve controls the interest rates from 2 years in. And as you can see by the spread between the red and the blue line, they significantly impacted the rates on the shorter end. When you start looking at 10 years out, you'll notice that the blue line actually is below the red line. And so interest rates in the longer term actually came down last year in the face of the Fed raising interest rates. This signals to us that the market may not necessarily be convinced that there is long-term inflation built into the prognosis of our economy. It also may be signaling that growth may be continuing to be at these lower, more depressed levels that we've seen, particularly in the last 5 or 6 years. Now, inflation, the bond market certainly does respond significantly to inflation, and the Fed has always had a target of 2% on the inflation, on 2% for inflation in the economy. One of the questions is how are we going to get to rising inflation, which is actually good for the economy? And one thing is, it could be that our new fiscal stimulus plan could stoke a little bit of inflation into our economy. This has been a conundrum for the last several years of the Fed, but we do anticipate the Fed to continue raising interest rates. And however, that being said, it's entirely possible to see an inflationary scare in the front half of this year. We did notice that commodities on the fourth quarter did have a pretty good showing. So with deficits being added, with fiscal stimulus being layered on, it's entirely possible that we may end up seeing a bit of a brief inflationary scare, but the bond market is signaling to us over the long term, there's not as much concern in the inflation space. Now, we always like to watch the dollar and figure out what's going on in the dollar. And as we've been doing this presentation for the last 3 years, we've been talking about how the dollar is strengthening. Pretty much as the calendar turned into 2017 last year, the dollar began weakening. So what exactly is going on with the dollar, and can this weakening dollar actually introduce some inflation? Well, we did include a $1.5 trillion deficit, and deficits are generally not very good for dollars. It's also possible that our trade policy could be affecting our strength of the US dollar. And we also have an administration that has been lately, most recently, jawboning that a weakening dollar is actually beneficial for manufacturers. That is true. However, a weakening dollar does make things for you and I and our consumers a bit more expensive. So again, this could be the beginning of a bit of inflation that the economy actually does need in order to continue moving forward. We'll continue monitoring this, but as of right now, it appears the dollar will continue to weaken. So as I mentioned, it was really a synchronized global growth effort. Here on the chart you're looking at is the developed economies. What's most notable about it is the bottom chart, you see the horizontal green line. That's the past 3 years, nearly 3 years in the developed economies. And then you see on the top chart is a 1-year breakout of the bottom chart. And what you're seeing is, again, similar to the S&P 500, a very healthy, low volatility, very limited drawdown staircase step of growth in the developed economies. Now, the developed economies looked at the Great Recession a little differently than we did, and it wasn't really until late 2015, early 2016, when they started to get together and decide to push monetary rates down low enough in order to stimulate asset price growth. Developed economies are going to be a little behind the U.S. economy in terms of where they are at the stages of their growth, but we are anticipating a healthy, strong global developed economies going forward, as they may be in the early innings of their expansion. Emerging markets, the same story there. Certainly this year, north of 30% return was incredibly impressive. But again, you had to go through quite a bit of pain for the past 3 years. Emerging economies are benefiting from monetary policy, but they're also benefiting from the fact that some of their policies are changing to becoming more privatizing in their economies. And therefore, again, another chart where you just saw very limited volatility going forward. So if we're looking at where do we put our money and what is the best trade-off, the red box on the left side is our U.S. markets. And as you can see where the dots are, U.S. markets are near their 10-year highs of earnings, or their 10-year high of valuation. And if we look on the right side, if we look in globally, there's a bit more value over in the global side. Your portfolio managers will be talking to you over the course of this year about the dynamic between U.S. and international markets and how we feel about international markets. If the U.S. is in the 7th inning stretch or the 8th inning of their expansion, we certainly do feel that these other markets happen to be in the more early and more infancy stages of the expiring growth. So where does that leave us? Well, this is my favorite heat map chart that we've had. It's a little on the messy side, but what we're looking for is green. Any number reading, this is a purchasing manager index. It helps us to identify whether an economy is expanding or contracting. The list of economies that we're monitoring is on the left-hand side. The way to read this is to see from left to right, you can see economies have gone from very stagnant, stale, and in some cases in the red down below, contracting, to now you're seeing what I had mentioned in the very beginning of synchronized global growth. We think this trend should continue into next year, and your portfolio managers will be talking to you about how your asset allocation is going to be for the coming year with all that we have going on. But next year sounds like a very good year to be shaping up, and I'll let Howard talk a little bit about taxes.
Thank you, Nina. I'm going to cover our special topic today, which is corporate tax reform. Here are the items I'm going to cover. First, I'm going to talk a little bit about the rationale for corporate tax reform. I'm going to talk about items that improve corporate profitability, and I'm going to cover 4 of the items within the Tax Reform Act that should improve corporate profitability. I'm then going to discuss items that could actually increase corporate taxes because Congress needed to figure out a way to at least raise some revenue to counterbalance the tax cuts that would certainly increase the deficit. And finally, I'm going to talk about changes to flow-through entity taxation. So let's first go to the first topic, which is what's the rationale? Since the Depression, tax cuts have been motivated primarily by the need to stimulate the United States economy. It has been a way to bring us out of recession and move the economy further. Not so much currently. There's really not a large need for stimulus in the economy right now. We are at what's called full employment. We're down to 4% as an unemployment rate, and the output gap, which measures the slack in the economy, whether we have capacity constraints or not. There's not a lot of slack in the economy right now. As you can see in 08 with at -6%, there was an enormous slack. An abundance means not that we're all abundantly wealthy, it means there's an abundance of slack in the economy. And currently there's not a lot of slack. So the traditional rationale for tax cuts, for economic stimulus really doesn't apply now. It's also an unusual timing for tax cuts because of where we are in terms of the debt-GDP relationship. As you can see, historically, by the black dots, that's when we had other tax cuts. And generally, tax cuts coincided with about a 40% debt-to-GDP ratio. We're much higher than that right now. We're close to 80%, and it will increase the debt-to-GDP ratio more than it would under current projections without TCJA. And by the way, TCJA is shorthand for the Tax Cut and Jobs Act. That's what Congress is calling the tax cuts. So if I refer to TCJA, I'm talking about the tax cut legislation. Another issue is that related to this is where we are in the cycle, and Nina talked about the length of time that we've been recovering from the recession. Typically, historically, the budget deficit is declining during that cycle. Here, the budget deficit is actually increasing over the last three years. So all of those impacts of a tax cut really don't apply currently. So why? And I think this chart gives the most complete explanation, and that is it makes U.S. corporate tax rates competitive internationally. So this is the tax rates, the marginal tax rates, the highest tax rates throughout the world. And the blue bar in the left-hand column is U.S. current, and this is before the Tax Act passed. So current, this is what things were before the Tax Act passed. You can see we are the highest in the developed world, making U.S. corporations relatively uncompetitive given the tax rate they'd have to pay. The proposed tax rate brings us, and that's the blue bar kind of in the middle, brings us in line slightly below. OECD is the developed world average. So the real motivation here was something that both Democrats and Republicans, although Democrats did not vote for this bill, even Democrats by and large recognized that U.S. corporate tax rates needed some reform. Their objections were to other aspects of the bill. Now, what is interesting, however, is that what started out primarily as being motivated by corporate tax cuts ended up benefiting individuals more than corporations. And this chart is a little bit busy, but I really want to focus on the red line at the top, and that is the net amount of individual tax cuts versus the net amount of business tax cuts. And you can see ultimately the individual tax cuts are significantly more than the corporate tax cuts. And we can speculate as to why, but I think obviously it had something to do with the fact that individuals vote. So now on to the second topic is what is the corporate tax rate cut precisely? And it permanently reduces federal income tax for U.S. corporations from 35% to 21%. As I just discussed, it makes U.S. rates competitive with other major developed market economies. It should increase most corporations' earnings per share, hence, as Nina talked about, a large reason for the increase recently in stock prices. And obviously, the extent of the benefit depends on the current effective tax rate for the corporation. And some corporations have been able to take advantage of deductions more than others, so it will benefit those that have higher tax rates. And generally, profitable U.S. small cap companies will be the biggest beneficiary. Because they pay the highest tax rate, and we'll see that in a second. But it is important to remember that in the Russell 2000, which is the index of small cap companies, about 34% of those companies are not profitable, and it will not benefit them whatsoever. This is another somewhat busy chart, but it shows that domestically oriented companies with large capital spending needs and normal levels of leverage, and we'll talk in a minute about those companies that have high leverage and how it may not benefit them quite enough as much, will be the biggest beneficiaries. And we can see that telecom, financials, and consumer discretionary really have the largest amount of domestic revenues. Now, I mentioned before that small caps could be the big beneficiary, and this is why. Small caps the median small cap tax rate is 31.4%, mega caps found at 27.2%. It's not a huge difference, but it's not an insignificant difference. And it should benefit all sectors. The blue line is the current effective tax rate for various sectors in the economy. TCJA, again, is the Tax Cut and Jobs Act, and that's the maroon line. And we see for every sector, it lowers the marginal effective tax rate. And by marginal rate, we mean the last dollar in, what you pay on the last dollar, because you pay obviously less on the first dollar of profit because, well, actually for corporate tax, it's a flat tax, but for individuals, we pay more on the last dollar than we do on the first. What's the other significant benefit? And this is really something that, again, was generally supported by both Democrats and Republicans, and that is that a change to a territorial tax system. The U.S. was virtually alone in the developed world in taxing overseas profits that were brought back to the U.S. By the U.S. corporate tax as well. So a corporation with overseas operations would have to pay not only the tax in the country where the corporate profits were earned, but also pay U.S. corporate tax when they brought that cash back to the U.S. Now, we did give a credit for the foreign tax paid, but you would still have to pay additional U.S. tax. Virtually all other developed countries in the world said, if you earn income in the foreign country, you pay tax in that country, and when you bring the cash back, you don't have to pay additional tax. So it really became an incentive to allow U.S. corporations to leave their cash overseas, and there would certainly be a domestic benefit if they brought that cash back into the U.S. So the act brings the U.S. in line with other developed nations and allows corporations to bring foreign earned profits back to the U.S. with no additional corporate tax. However, Congress wanted to ensure that the pre-2018 corporate earnings sitting overseas actually came back to the U.S. And this is something Nina mentioned in her presentation. It's called repatriation. And so they wanted people to repatriate the money back to the U.S. Now, how do you do that? Because there's no penalty, typically, if you just hold it offshore. Well, they did, in a way, impose a penalty, which is what's called deemed repatriation. It's a one-time tax on earnings held offshore, whether or not you bring those earnings back to the U.S. And repatriation means bringing it back to the U.S. So if I kept my earnings that I made in Germany, I paid the tax whether or not I brought it back to the U.S. So there's clearly no reason not to bring it back. The tax is 15.5% on cash and cash equivalents and 8% on reinvested earnings. Just to give you the scope of the problem, the Congress estimated that there are 2.6 trillion of untaxed earnings sitting overseas, 900 billion in cash and 1.6 billion in non-cash. And the Congress estimated that repatriation raised approximately 348 billion over 10 years, mostly concentrated in 2018. Now that's what the government will earn in taxes. The amount that will be brought back into the economy is far greater. And that has also been, as Nina said, a significant reason the market has run recently. Now, the big question that we all have, not only from a share price point of view, but from an economic point of view, is what will corporations do with these repatriated profits? We previously had a repatriation holiday several years ago, and what we found in that situation was that most of the money was spent on corporate buybacks. So corporations bought back their stock. This certainly improved and helped stock price, but it did not provide what Congress was hoping for, which would be R&D spending, research and development spending that would potentially increase employment down the road. Well, there is a survey that was taken of 302 companies about what they would do with their corporate cash. Now, obviously, this is going to add up to more than 100% because you can give more than one answer because there's more things that you can do with your cash than one thing. But the primary thing that they were going to do is pay down debt. Second was share repurchases. Third was M&A, and CapEx came in fourth. But obviously, 1 and 2, as well as 3, will help equity prices. Why is pay down debt number 1? Well, think about it for a second. If you had a bunch of cash overseas and you don't want to pay the tax on it, but you wanted to raise money, given interest rates are so low, you might as well borrow. And this chart shows that there is definitely a correlation between the cash held overseas and the amount of debt a corporation owns. Once they bring that cash back, they can simply pay off that debt. Excuse me. If there is buybacks, what is the implication? And this is a chart that analyzes the implication, and I want to focus on the bottom rectangle. And it talks about buybacks from repatriation. So if 38% of after-tax overseas cash, and that's the second column from the right, comes back, that's $1.50 per share increase. And that's around where the survey is. And that's a significant increase. The other thing that increased stock buybacks would do is they take place at a time when growth in net equity supply is already low. Corporations throughout the world have already been buying back their stock, and the stock of equity, the growth in the stock of equity has dramatically declined. There's been very little growth in the stock of equity. When I say stock of equity, the amount of equity is available. It's already low, and buybacks will decrease that. And in a supply-demand equation, of course, that just means more demand for those fewer issues outstanding. So the next issue that's going to benefit corporations, the next 2 issues, and I'll go through these relatively briefly, is immediate expensing and / bonus depreciation, and the repeal of the alternative minimum tax. So the Act allows for most tangible property, not including real estate, acquired between a narrow four-year window to be fully expensed during the first tax year in which it was used in the trade or business. After that time, an amortization kicks in. And what that means is a full expense means you can offset earnings for the entire amount of the equipment that you buy in the immediate year that you buy it. Usually you would have to take that slowly over time periods. It applies to both new and used assets, as long as it's the taxpayer's first use of the asset. So think about it. It really would encourage one company to buy another that had a lot of plant and equipment, because they would be able to take a big write-down in the year they purchased it. So in this narrow time frame when you can expense it, you may see some M&A activity, especially for plant and equipment intensive businesses, because the acquiring company, it would be their first use of those assets and they'd be able to offset income. The second major thing is the alternative minimum tax for corporations has been repealed. It has not been repealed for individuals, only corporations. So what could increase U.S. taxes? Where is the counterbalance so that the budget deficit doesn't balloon completely out of control? And there's a few of those. And the first is that the Act limits interest deductibility to 30% of EBITDA. And EBITDA is a measure of earnings. It's earnings before interest, taxes, depreciation, and amortization. And if you have, essentially, if you have interest debt that is more than 30% of your EBITDA, you don't get to deduct that debt, and you do currently. In 2022, the limitation becomes more stringent and applies to earnings before interest and taxes only. I'm not going to go to the nuances of those, except to say that EBIT is a much stricter limitation, and it's going to cause a lot more corporations to be caught in the net. We'll see that in a second. There's no grandfathering for debt issued prior to the enactment of the Act, and it will highly impact highly leveraged companies and change the structure or perhaps impair certain private equity transactions, especially things like leveraged buyouts. There may be some ways they're able to restructure around it. In other words, have the buyout not be from debt, but have it be preferred stock. But it's going to make private equity, especially LBO's life, more difficult. Real estate companies can opt out. So interest deductibility, we talked about how tax cuts help small caps more than large caps. Interest deductibility hurts small caps more than large caps. We can see in the left-hand column the S&P 500 and EBIT and EBITDA. So I mentioned that EBIT is a bigger hit than EBITDA. So 3% of S&P 500, only 3% of those companies are caught up in the new interest deduction limitation right now. 14% of the Russell 2000 is. When it goes to EBIT as opposed to EBITDA, both increase significantly. And the impact of the EBITDA rule is not really projected to have a significant impact on equities. It will have more of an impact on high yield companies that raise money through the high yield debt market. Not that dramatic for the EBITDA rule. So the percentage of the market, the left is the percentage of the market affected, and the right is the impact on free cash flow. But it will have a much bigger effect when EBIT kicks in. Almost 40% of the US high yield companies will be hit by that in one way or another. Now, there is a big question in my mind when 2020 or 2021 come around, where they actually will implement the EBIT rule, because it will have such a significant effect. So the other issue regarding increasing corporate taxes is what's called net operating losses. Corporations have operating losses. They can deduct the full amount of those operating losses against their income. Now they can only offset 80% of their net operating losses in any year. So that's going to cause a higher tax bill for some companies. They can be carried forward indefinitely. In other words, if you can't use them in 1 year, you can use them going forward. And it only applies to losses beginning in 2018. So in 2017, you can deduct the full NOL. So what's the earnings impact estimate? And this is JP Morgan's, not ours, earnings impact. And this is the Senate bill and the House bill. The end result was much closer to the Senate bill. Consensus earnings per share in 2018 is it's $146 per share. I'm not going to go through every line item on this, but the bottom the total cash flow benefit, they're talking about $158 a share as opposed to the $156. So the 5% to 8% increase that Morgan Stanley estimated from the act would be in addition to the 8 to 10% increase in EPS growth that they already projected. So a nice hefty bump reflected, and maybe over reflected, but certainly reflected in the stock market. The final thing I want to cover today is flow-through entity taxation changes, and please bear with me, this is a bit complicated. Let me first, for those of you who may not be familiar, tell you what flow-through entities are. C corporations are the corporations on the U.S. Stock Exchange. They're the large U.S. corporations. That's the one that the Tax Reform Act will benefit. They tax at two levels. They tax at corporate level profits, and when those funds are kicked out to shareholders, they're taxed again on the dividend paid. S corporations and partnerships are not taxed at the entity level. The profits flow through to the shareholder or the partner, and those are taxed at the individual rate. LLCs are unique. They can elect whether to be taxed as a corporation or a partnership, but the overwhelming number of LLCs, at least that I'm familiar with, elect to be taxed as a partnership. So you're paying the partnership tax and you're not getting the individual tax rate. Even though you're in a business, you're really not getting the benefit of the tax cut. So they wanted to provide relief to owners of flow-through entities who were individuals, and they wanted, since it was essentially a business, they wanted them to pay the business tax rate as opposed to the corporate tax rate. It does not apply, however, to law, accounting, and financial services and other service-related businesses. So the provision applies to income generated by business operations of certain entities that are located in the U.S., and this is defined as qualified business income. And it provides a 20% deduction for this type of income. Now, here's where it gets complicated, and bear with me, but it is limited further to the greater of an owner's share of 50% of the owner's share of the W-2 income paid. So if my interest in the company is 5%, it's greater. It's that proportion of the 50% of the owner's share of the W-2 income that's paid. So they want operating businesses that actually pay cash. To actually have employees, or 25% of income plus 2% of qualified property. Again, that is a benefit for real estate companies. The wage restriction or the service business restriction does not apply if the taxpayer makes less than $315,000 a year jointly or $157,000 a year singly. Okay, what's the bottom line through that complexity? The bottom line is that if it applies to you in your LLC, it brings your top marginal rate down from 37% to 29.5%. So if you own shares, if you're a corporation, or interests if you're an LLC, or partnership interests if you're a partnership in an operating business, talk to your tax accountant, because this flow-through benefit may certainly help you. Well, that concludes our call for the fourth quarter of 2017. We really thank you for your attention. We've run over. Unfortunately, we don't have time for questions. Thank you very much, Nina, for a good presentation on the market update. And please take your questions to your relationship manager or portfolio manager. We apologize for not getting to them, but we have run over already. Thank you again.